So, hello, everyone. Good morning, good afternoon, depending on where you are. I'd like to welcome everyone to this side event on blended finance to mobilize private capital for clean energy, and thank all of our participants and panelists for joining us today. My name is Cecilia Tam. I head up the OECD's Clean Energy Finance and Investment Mobilization Program. And I'd like to thank our partners, the European Investment Bank and the Climate Investment Coalition, for co-hosting this side event with us today. Thank our distinguished group of speakers for joining today's session and spending the time to share with us their experience in developing and implementing blended finance mechanisms to mobilize commercial capital for clean energy. Our panel today is comprised of Matthias Wodtke, Head of Structured Products at the European Investment Bank, Torben Morger Pedersen, CEO of Pension Denmark, and also representing the Climate Investment Coalition, Mohammed Ghozi Indra Dalal, Director of Project Development and Consultation Services at PTSMI Indonesia, Connie Tsulis from the Climate Finance Investment Team at Global Affairs Canada, Mohammed Sayed, Climate Finance Specialist at the Development Bank of South Africa. And finally, we'll also later be joined by Haya Schut, Head of Financing for Sustainable Development at the OECD. Our panelists will share their perspectives on how blended finance can play in supporting investments in clean energy and how we can use limited development finance to help catalyze private capital and help emerging and developing countries create clean energy markets and facilitate access to both domestic and international commercial capital. The session will explore the opportunity to develop an energy compact on blended finance for clean energy as a way to mobilize action and support countries in developing more effective blended finance schemes that can maximize commercial capital for clean investments and support the development of innovative energy solutions. Each panelist will have 5 minutes to provide initial remarks, and I kindly ask you all to stick to that time, and then we'll move to a Q&A session where participants are invited to submit their questions online through the Zoom Q&A function that everyone can find at the bottom of their screen. So with that, I'd like to invite our first speaker, Matthias Wodtke, to help us kick off today's session by introducing the blended finance recommendation in the Finance and Investment Theme Report that was launched yesterday. Matthias, the floor is yours. Thank you.
Thank you so much, Cecilia. It's a pleasure to be here today, and it's of course maybe a bit difficult to stick to the 5 minutes, but I mean I will do my best. I mean the theme that you gave me is to report a little bit back on the works on the theme report, and in particular the recommendation when it comes to blended financing. The theme report was concentrating on 4 priority areas actually, just to give the audience also a bit the background on how to situate the blended financing element in that. And these were like, first of all, Paris alignment of all the financing flows that we are considering. So basically make this sustainable in this particular way, make it inclusive and sustainable. Make it locally based and based on local knowledge. And the third, I think, very important priority area is to create a significant and solid pipeline of de-risk projects that and clean energy projects that can attract investors and sponsors. Within these 4 priority areas, there were 9 recommendations that the working group came up with. These are like, I mean, just to give you the buzzwords, were like the market distortion must be thwarted. Delivery, acceleration of the delivery of public finance solutions. De-risking projects, leave no one behind. Sustainable financing, aligning energy financing with Paris alignment. We already had this with Paris Agreement. Local currency funding and domestic capital markets were quite important themes that came up, because we're going to talk about this maybe in a second. And then of course, energy access financing, and the 6 of these recommendations then concerned blended financing. indeed, the discussions were quite large because it is not necessarily easy to define, and anything that is or could be treated under blended financing. So there was a lot of definition work which went into this, and I think there were various angles from the various institutions that flew into that. Indeed, when what we considered as a working group as being within this area of blended financing is blending commercial lending with all sorts of things, whether it be grants, concessional financing, loans at project level and at portfolio level, and also giving different technical aspects to it. May this be first loss protections, de-risking, or a project preparatory and development funds. And in the end, of course, a part of this, very important, which was outlined by a lot of participants to the working group, is also, of course, technical assistance. I think we all agreed that we need to tackle this massive investment needs that we see in front of us in order to achieve the energy transition and the investment goals until 2030. We all agreed that we are late when it comes to the fulfillment of these targets, and that there must be decisive action taken. Of course, these let's say a forum which is so exposed and so very varied in backgrounds is not necessarily the easiest to combine, but I think that the theme report and the recommendations, they were actually quite focused and gave a good perspective there. We have identified players. So who are the players who actually are in the field of blended financing? And we of course see institutions including multilateral development banks, we see bilateral, we see national development banks, we see export credit agencies, private insurance companies, banks, DFIs, etc., etc. So who can use that? And I think we all agree that blended financing must play a catalytic role in order to foster investments in clean energy. And clean energy in the widest of senses, actually, may this be transmission, may this be generation, may this be a decarbonization of heavily energy consuming industries for the time being. The working group also said that the blended financing is particularly important for supporting new technologies, sectors that are in a very high need to reform themselves if the SDG 7 is to be met, in particular like steel, cement, things like that, chemicals, shipping, aviation, and of course energy efficiency programs, which are difficult to basically finance or put a bankable project around. Of course, we were overlapping with a lot of the themes that I mentioned before. So I mean, of course, fostering a bankable deal pipeline it can be tackled from various angles, and of course there were other recommendations that are cited that we're also going in this direction. So regulatory support, sovereign support, but in the end, I think when we come to blended financing, I think the role that it plays is leveraging, blending together private and public funds, leveraging investments there, and giving opportunities to investors to bring their money to the right people. And of course, I mean, what I think is one of the global themes there is that it must happen locally. So the availability of liquidity right now is not necessarily there where we want to see these investment happen. So we need to bridge that gap, and we need to somehow rely on local partners, and of course build capacity locally in order to bring bankable projects forward. Of course, the development of capital market access also to local currency. I mean, these are themes that have been developed separately, but they I think play an important role also in the context of blended financing in order to hedge risks, in order to give access to resources that give local players actually a natural hedge against currency variations. And maybe then last but not least, we should mention that the increased technical assistance is something that has been singled out by a lot of players in order to fill the gap and in order to have the capacity to identify, develop, and finance a pipeline of projects which is ready and which can be built anytime soon. Because I mean, let's face it, we are having a time constraint and time is running out. And I think it's very important that we concentrate our efforts in there. We also considered, of course, I mean, in these type of instruments, you have from equity to loan, you have a whole lot of instruments that can be deployed. We thought, if in the sense of like scalable investments, we thought that there's one thing that popped out that might be the creation of a multilateral portfolio guarantee scheme. This is where we confronted a little bit what the co-leads of this working group have seen in their respective institutions. So the co-leads being the International Energy Agency, the UN Economic Commission for Africa, and IFC, of course. So we had our views on that, and of course EIB has also had its experiences when it comes to this type of use of leveraged use of budget funds, in particular when it comes to the investment, the European Fund for Strategic Investments, so the EFSI, which we have done in cooperation with the Commission, the European Union, over the past 7 years, so in the last budgetary period. So we entered also an annex into this particular recommendation where it is showcased how this could be done, and with the hope that this might be something that that could be considered. Cecilia, I understand you. I will stop here. I just want to finish on a positive note, which was that the cooperation between co-leads and participants was excellent, was open, and that we truly hope that this might bring some movement into this particular discussion. Thank you.
Thank you very much, Matthias, for taking us through the theme report. I did give you a very difficult challenge to get that all in a very short amount of time, so thank you for that. Now, I'd like to get the perspective from those trillions of dollars that we're all talking about to target in terms of trying to mobilize more institutional and commercial capital, and turn it over to Torben. The floor is yours.
Thank you very much for this opportunity to share our experiences in the area of blended finance for clean energy with you and all out there behind the screens. My name is Torben Petersen. I'm CEO of Pension Denmark, a Danish pension fund which have been involved in, as a climate-related investments for more than a decade. In the beginning, only in, let's say, developed economies, Europe, North America, but recently we have also found ways to get involved and get an exposure to the emerging market area when it comes to clean energy. And from a risk perspective, at least the perceived risk for a Danish pension fund entering into investments in, let's say, Latin America, Africa, Asia, is higher than investing in clean energy in our part of the world. So we have to establish structures, vehicles with some kind of risk mitigation. And our choice has been to engage in exactly blended finance structures. Together with the Danish government's DFI, as funded by the Danish government and the Foreign Office in Denmark, we have established now 3 blended finance structures managed by the Danish DFI. One on specific on climate, one on sustainable agriculture, and then a more, let's say, holistic fund called the Danish SDG Investment Fund, which have a broader perspective than only clean energy. We combine, let's say, public money from the states with investments or commitments from private pension funds. Private pension funds account for 65% of the investments, and the government for the rest. And we have established a structure where the government accepts what you could call a first loss position, which means that the first chunk of returns goes to the private investors. Then we share returns, but when we pass a return target of, in this case, between 10 and 12%, the majority of this part of the returns goes to the government. So we are trading, the private investors are trading away some of the upside to get a downside protection, which gives us a more comfortable view on the total risk involved in these kind of investments. This has been very successful, and we have been involved in a number of also clean energy investments in these structures. And I will only mention one example. We are one of the big investors in the Lake Turkana wind power project in Kenya. It's the largest onshore wind power facility in Africa, and provides Kenya will produce approximately between 20 and 25% of total power in Kenya, which previously was produced by coal or oil-based utilities. So this is a good example of by using public and private money in a creative manner, we can mobilize private capital at a relatively large scale to invest in clean energy. And I think it's important to realize that investing in this case wind powered electricity is not only let's say a energy issue. It's actually, it taps into most of the UN's SDGs. Just to give you one example of this, the first power produced by this Lake Turkana wind power farm went to some of the villages along the T line, which had not been which were without electricity before, which means that they now have electrical pumps for their wells, and you have light in the houses, meaning that the women in these villages are not longer forced to use many hours a day to collect water. They can use the pump, and the young women, the girls in the village, can actually do their homework by light. So there's also a big diversity and gender issue in providing clean energy to all. I think it's very important to have this holistic approach when you are evaluating the impact of expanding the clean energy area. This is a public-private partnership, but which is necessary in let's say areas where the perceived risk is high. But there are also areas where we don't need a public co-funding. We have together with the large Danish shipping company AP Møller Mærsk established what you call the African Infrastructure Fund, funded wholly by private funding from pension funds, investing in sustainable infrastructure in Africa, ports, energy system, transmission facilities, and together with some other partners, we last year established what we call a new market fund, where we use our experience in developing and building offshore wind farms in Europe and America to do the same thing especially in Asia. And we are now involved in what will become the first offshore wind farm in Vietnam, where we are actually transferring our expertise and competences, experience from building offshore wind farms in Europe to, in this case, Vietnam. And we will expand this into Malaysia, Indonesia, the Philippines, and probably also India during the next 2 or 3 years. So I think that there's really big perspectives in using blended finance as a starter. We don't need to have blended finance for the whole road. At some time, we have the stuff being so mature that you can, let's say, skip the public part of the structure and use those funds where they are most needed. But my last remark is on, let's say, maybe a broader basis. I think you should be aware of the fact that the movement among asset owners, institutional investors all over the world towards a stronger focus on climate is very strong in these years. 2 years ago, in September 2019, Pension Denmark, together with some other pension funds in New York during the UN Climate Summit, established what was called the Net Zero Asset Owners Alliance. At that time, we were 12 members. Now we are more than 50 members. And when we reach the COP26 in Glasgow later this year, I think that this alliance will cover almost 50% of total pension fund assets in the world, having committed themselves to make their portfolios carbon neutral by latest in 2050, and also using milestones for 2025, 2030, and so on, and not by divesting and only investing in green darlings, but by engaging with companies in the industries where what we call high abate industries, and assist them in transforming their business models in a more, let's say, climate friendly way. That goes with shipping, with cement, with agriculture. I think these experiences should be also transferred to emerging markets and also injected into the both existing and coming blended finance structures. And we will be very happy to share our experiences, both the good and the less good ones, with all of you in the coming time. So, thank you.
Thanks very much for those remarks. And it's great to end on a very positive note, showing that there is an incredible amount of interest amongst institutional investors in good project opportunities, and a clear willingness to invest, highlighting where blended finance can play a role, and important message around ensuring that there is an exit strategy when it's really no longer needed. Now, OECD has been working very closely with Indonesia on blended finance, and the country has been leading efforts under the Trihita Karena Blended Finance Roadmap. The SDG Indonesia 1 Blended Finance Facility, managed by PTSMI, is one of the largest funds of this nature. And I'm very happy to ask Pak Gozi to tell us more about Indonesia's experience under the SDG 1 facility. Pak Gozi, please.
Hi, thank you. Hi, Cecilia. Hi, everyone. Thanks for inviting me to participate in this event. So first of all, probably I would like to explain a bit about Sarana Multi Infrastructure. SMI is actually a national DFI, 100% owned by the government, reporting directly to the Ministry of Finance. And we are a financial institution focusing to finance infrastructure with a vision to become a catalyst in accelerating the national infrastructure development. And when we mean by development is sustainable development. We have, on top of the financing programs, we also have the advisory and project development, especially to engage on the PPP projects in Indonesia. And we are supporting specifically in infrastructure sector, like toll roads, electricity, renewable energy, energy efficiency, and also some social infrastructure like hospitals and others. Our size is about 8.1 billion US per May 2028, when we are as a sovereign rating company. And for Indonesia itself, in 2015, when our president joined the COP21 Paris Agreement, we committed to have 29 reduction of greenhouse gas emissions with our own efforts, and 41% without with the international support. And in this case, if you look at the clean energy, the target from Indonesia is to have an energy mix of 23% in 2025. And for end of 2020, we only reach about 11.2% clean energy. So there's a number of ways, number of increase that we need to work together. And I think the ministries and the parties are really pushing how to get this achievement to achieve the energy mix. And if you look at PT-SMI itself, we currently have the portfolio of a lot of clean energy in hydro, mini hydro, biomass, solar, and I think we have one in wind and geothermal. And since 2019, we have an internal direction from our CEO to stop financing the coal-fired projects. Although this is still an internal direction, we already stopped financing new coal since 2019. So hopefully, and if you look at in Indonesia, there's a lot number of renewable energy. We have lots of potential of geothermal. And when you talk about the renewable energy and the clean energy, the challenges that we have currently is we have a very limited sponsor capacity. Sometimes the project preparation is not adequate enough. Yeah. And then there's a support from the government policies on tariffs, because now if you are looking at the renewable energy tariffs, the price is considered high. So I think the government is planning to issue the presidential decree on the tariffs on the government support to make sure that the tariff is actually getting better for the renewable energy. And in 2018, October 2018, we are with the Ministry of Finance, we are developing a platform called SDG Indonesia One. And in this platform is actually until now, we already have about 3.3 billion commitments of funding, of financing. And we are working with 33 partners, let alone government agencies, development financial institutions, climate funds, philanthropies, financial institutions, and others. So basically, with this SDG Indonesia One platform, what we are trying to do is create programs, 4 programs that the partners can participate. Number one is talking about the development facilities, can be about the technical assistance and the other. And number 2 is about the de-risking, when the partners is trying to have grants to support the de-risking products, concessional loan and others. Financing facilities, this is a commercial loan that is to mobilize commercial loan to the infrastructure projects. And the last one is equity participation. So within these programs, we are trying to create how to really channel and do some product innovation to support and build some renewable energy or clean energy pipeline. And as first quarter of 2021, we already have about 19 projects, 9 activities, and we have mobilized funds is about 791 million US. And we have some specific programs to help out to support the renewable energy development. For example, in geothermal, we are working using the funds, the grants from World Bank. We have a government drilling program. So we are using this grant to help to get the exploration stage. And then after we have a proven data, then they can have, the government can have an auction to get the developer to participate in this further development. Hence, it reduces the risk of the exploration side. Another part is actually, we have also relating to geothermal, we have a GRAM project. So GRAM financing is actually a blended financing mechanism that also targeted in exploration. However, the subjects that we are targeting is actually part of the developers that already won the tender. So in this standard blended financing, we are combining 50% of the World Bank loan and the 50% of the grant. So whenever the exploration process is successful, they're just paying like a loan. Yeah, they just pay principal and interest. However, if let's say after the exploration process that the potential is not there, or they cannot find any potential of geothermal to move on, then the 50% of the grant portion can be forgiven. So hopefully this can be some sort of de-risking mechanism for the developer and encourage them to use SAP, and so they can pass the exploration program, because usually the exploration phase they are using mainly equity. So hopefully when they pass this stage, they can go to the construction and the banks can come in and support that. And another part is actually we are also working on the feasibility study support, specifically to the renewable energy that is very fast to implement and also very mature technology like a solar rooftop. So we do have a contract, for example, to do a feasibility study in the Indonesian airports. And hopefully after this feasibility study, then the airports or the energy company can create some sort of offering that can be proceed with the development of the solar rooftop. And on top of this program, we're still working to find out other means of solar rooftop, for example, like a solar rooftop in the industrial area, and then other government buildings, and probably in the dam area where you can floating solar panel. So this kind of project. And on top of that, we also have a grant that to support the feasibility study to make on the 7 or 8 mini hydro power plant potential. So hopefully when this project is feasible and bankable, we will proceed to the next phase, which is financing. And since last year, 2020, we are also part of the association of the initiative of the Indonesian banks, although we are not banks, but the 8 big banks in Indonesia. And in this place, we are trying to encourage and bring the capacity of the bank so they know what are the projects, so they can later on the safe stage help to engage in the financial financing these projects. Last point, probably because the time is already up. In doing this, I think we need to have regulatory support. So hopefully the presidential decree to help the new renewable energy will come up soon. And ecosystem collaboration is actually very, very important from the regulation, developer, financial institution, and the others. So, and the main tagline is actually together we can make a difference. So I think that's the end of my sharing. Lucia, thank you.
Thank you very much, Pakosi. And I like how you ended with the important message around having strong regulatory frameworks around supporting renewables development. And thanks very much for sharing that wealth of support that SMI has planned under its own facility. And we do hope that will lead to a big uptake in the renewable and clean energy market. Next, Torben already kindly raised the importance of gender equality and women's empowerment in his remarks, but I'd like to ask our speaker from Canada to share some of their experience in developing gender responsive blended finance incentives and how this can really enhance resource mobilization for clean energy as well as improve equality. Connie, the floor is yours.
Thanks very much, Cecilia. And thank you for inviting us to this panel. I'm very honored to be among such distinguished panelists. So as Cecilia mentioned, the experience that I'd like to share is how Canada has used blended finance, not only to mobilize public and private capital for clean energy, but to do so in a gender responsive manner. This is a really important discussion because we know that the world's ability to meet both the Sustainable Development Goals and the Paris climate targets hinges on a rapid and just transition to climate resilient, affordable, low carbon energy systems and enabling infrastructure. At the same time, we know that vulnerable populations, particularly women in all their diversity, are disproportionately impacted by climate change because of the roles they tend to play in the household and because they have less access to the resources they need to help them cope with the damaging impacts of climate change and to take advantage of the opportunities from efforts to combat climate change. And within these efforts, women can be powerful sources of knowledge, leadership, and agents of change. For all these reasons, it's essential that investments in climate change mitigation and adaptation solutions include explicit efforts and incentives to support women's active participation, leadership, and decision-making. This dual leadership potential and systemic vulnerabilities of women is the major reason why Canada, through the Feminist International Assistance Policy, puts women at the heart of all our development assistance, including for climate change. Through both our Fast Start and 2.65 billion climate finance programs, and moving forward under our recently announced 5.3 billion climate finance commitments, we work with our partners to promote green energy solutions and create employment opportunities for women within this sector. So I'd like to share an example of how we've used blended finance to support investments in renewable energy infrastructure that were gender responsive. Under our previous climate finance commitment, Canada established the Canadian Climate Fund for the Private Sector in the Americas program, or C2F for short. The aim of this $250 million fund is to catalyze private sector climate investments by providing concessional financing to incentivize the private sector to invest in climate change mitigation and adaptation projects. The C2F is expected to mobilize $2 billion in investments towards low carbon and climate resilient infrastructure and reduce 25 million tons of GHG emissions. It has helped to provide a demonstration effect or scaling up of over 20 projects across 10 countries in the Americas. One unique feature of the C2F is the innovative way in which blended finance was used to achieve strong gender outcomes. Our partner, the IDB Group, created a performance-based incentive program to encourage its private sector clients to integrate gender considerations into their operations. Companies that meet codified and agreed upon gender targets can apply for a discount on their loan's interest rate. These led some private sector companies to provide internship opportunities for women undergraduates in STEM fields where women continue to be traditionally underrepresented. Other companies updated their human resources policies and practices to provide work opportunities for women in engineering and other technical fields in the renewable energy sector. Yet others signed on to the UN's Women Empowerment Principles or received certification of compliance with government standards on workplace equality. While these achievements are noteworthy, I think what's more important is the awareness that has been created and the demonstration effect of the value of integrating more women into the workplace. Conversations about gender equality in the workplace that would not normally have taken place have been happening in a number of companies. Similarly, management in many companies have become more sensitive to gender issues in the workplace, as evidenced by the number of CEOs who committed to UN Women's Empowerment Principles and by the development and implementation of a gender action plan. We've also seen some unintended consequences that ended up being systemic in nature. In a wind energy project in Argentina, for example, the IDB group was able to widen the conversations to the national and even international levels. While working with a company on developing a gender action plan, they discovered that women were prohibited by law from participating in labor activity deemed risky in Argentina. This law prevented companies from hiring women in non-traditional sectors, like construction in the renewable energy sector. So the IDB group has since coordinated efforts to influence the gender equality conversation directly with policymakers in Argentina and to encourage them to review and modify this law. They've even included this topic in the agendas of international fora such as APAC. C2F interventions on gender equality have also been instrumental in developing knowledge on how to engage with the private sector in the Americas and how to structure financial incentives effectively. This know-how can be applied across sectors and financing instruments to help inform innovative financing solutions at the intersection of gender equality and climate action. Our main takeaway from the C2F is that with alignment of interests, it is possible to combine financial and non-financial capital for impact to advance the 2030 agenda. As we work to implement our new climate finance program, which our Prime Minister just announced on the margins of the recent G7 summit, we'll continue to apply lessons learned from our current programming, and we're excited by the opportunity to be able to continue on our journey to help developing countries transition to low carbon and more climate resilient economies in a gender responsive manner, and to learn from others such as yourselves. Thanks again for providing us this opportunity to share our experience.
Thanks very much, Connie, for sharing and showing Canada's leadership in supporting gender equality around the world. I'd like to remind participants that you can submit questions on the bottom of the online feature, and thank those who've already done so. So Africa is one of the regions where we've seen already a lot of experience developing blended finance for renewable energy development. And I'd now like to turn to Mohammed and the Development Bank of South Africa's experience with blended finance. Mohammed, the floor is yours.
Thank you so much. So I think in terms of the DBS's experience, in terms of using blended finance mechanisms to support, the clean energy sector, we've looked at different programs to date over the last few years. And what has been quite key for us is, trying to mobilize, firstly, climate finance mechanisms to try and use that to develop these blended finance facilities. And we've had some success, to try and launch, some of these facilities over the last 2 years. So obviously, the accreditation with the Green Climate Fund was quite important in terms of trying to utilize GCF resources, whether it's in the form of the different types of instruments that the Green Climate Fund can offer to help establish these type of facilities. So to date, we've launched 2 programs, which does talk to the clean energy space. So the one is a climate finance facility, which is a blended finance mechanism where we blend a green climate fund resources in the form of a highly concessional loan together with GCF resources to offer credit enhancement in order to entice private sector to start supporting climate mitigation and adaptation projects. So the climate finance facility focuses on a number of areas. On the mitigation side, we look at renewable energy efficiency projects, clean transport, as well as the water sector on the adaptation side. We've tried to obviously align those sectors with the DBSA core mandated areas. And we believe that the type of credit enhancement that we offer through the CFF, which is essentially subordinated debt, first loss, coupled with tenor extension, you're providing long tenor loans, is quite attractive, to crowd in senior debt from commercial banks. And, the long tenor loans is quite important for commercial banks in particular because of, Basel regulations, where a lot of banks cannot, provide finance beyond 7 years. And with renewable energy projects, spanning 15 or in some cases 20, 25 years, that particular credit enhancement, has been quite key. So we believe, that mechanism, is showing a lot of traction to date. We've already approved 2 projects under this particular facility, bearing in mind we only launched this facility about a year and a half ago. And we are already seeing a lot of interest from other national development banks in the region to replicate that model, which was based on a green bank kind of model, but adapted in the South African context. And this facility is embedded within the DBSA. Another program which also looks at a similar blended finance mechanism is the Embedded Generation Investment Program, which we also launched with the Green Climate Fund. So Green Climate Fund approved $100 million USD, in the form of a concessional loan. And to try and set up this particular program to support embedded generation projects in South Africa. And the idea there with that particular blended finance facility was to try and de-risk, once again, these projects which are not backed by sovereign guarantees. So, of course, everybody, may be quite aware of the successful REAP program in South Africa, the Renewable Energy IPP program, which has been running for, over a decade. So while that has been quite successful, it's very much dependent on sovereign guarantees. So we wanted to find an alternative procurement mechanism for renewable energy in South Africa, and more particularly embedded generation. So this particular blended mechanism, which also entails using credit enhancement, similar to what the CFF offers, we believe, is a good alternative in terms of supporting the embedded generation projects in South Africa. And 2 weeks ago, our president in South Africa announced, the lifting of license requirements for embedded generation projects from 1 megawatt to up to 100 megawatts. So I think our program would be, well positioned to hopefully support a number of projects, in that particular, capacity. Where the embedded generation program supports projects from 10 megawatts up to 75 megawatts. So the whole idea with this particular program is to try and create a market for embedded generation in South Africa, and to demonstrate, that we can back non-sovereign renewable energy projects, and to demonstrate, to the relevant stakeholders the value of developing a renewable energy program outside the government-led REAP program, the Renewable Energy IPP program, as well as serving some sort of validation for developers, IPP developers, especially when it comes to solar and wind, and lenders in this regard, that this new alternative procurement program, can be bankable. And last but not least, we hope that this program will accelerate progress towards achieving, obviously, the ambitious targets that we want to put in place around climate mitigation, and of course adaptation. But of course, this particular program talks mitigation in particular, and also create a platform where we can learn and improve the current legislation with regards to embedded generation in South Africa. And it's obviously very fluid at the moment, but we hope this particular program will be able to facilitate that process as well, the policy side of it. We obviously, I think we applied, we thought of this program back in 2018, and I think we were a bit ahead of the time in terms of, just seeing changes happening now. But we believe over the next few months, there will be significant traction in terms of supporting blended finance, supporting renewable energy projects through these blended finance mechanisms. Last but not least, just following up on what Connie just mentioned around gender mainstreaming, I think you may be aware that with a lot of Green Climate Fund projects, gender mainstreaming is absolutely crucial. So with both the renewable energy embedded generation investment program, as well as the climate finance facility, we have a very strong gender mainstreaming component incorporated. So we have a gender action plan for both programs. And the expectation is all the sub-projects that would be supported through these blended finance facilities would need to have a gender action plan as well that talks to the program as well. So I think that that's something I just wanted to highlight. Sorry for rushing through the those summaries, but I think in a nutshell that gives you a sense of what we try to do to date in South Africa and also the Southern African context, because the climate finance facility covers all ZAR-dominated countries. So we're looking at, apart from South Africa, Lesotho, Eswatini, and Namibia as well. But we hope to replicate that model in other SADC member states. Thank you so much.
Thank you very much, Mohammed, for taking us through those examples. And we do hope that things will take off under those programs. So last but not least, our final panelist for today's session is my colleague, Haya Schut, who will help us to round out our panel and highlight opportunities to apply the OECD's blended finance guidelines into the clean energy sector, and also how we might be able to link with the UN high-level dialogue on energy's work. Haya, please go ahead.
Yeah, thank you, Cecilia, and thanks for inviting me also to join this panel. It has been a fascinating listening, I have to say, to my fellow panelists. I learned a lot, and I think the richness of the experience and the know-how that has been presented is really super. I mean, as you all know, the OECD has been working on blended finance, on the mobilization of commercial capital through the means of development finance for quite a number of years, with many of the analysts and their institutions here as well. And I think while we all know that the energy sector, and especially support for renewable energy, has been one of the sectors that has seen most of blended finance being mobilized, I think we also clearly know that we need to scale up in quite a different magnitude. And the experiences shared by the colleagues from Indonesia or South Africa, I think obviously indicates very clearly the potential that there is. A couple of days ago, you may know another OECD report was launched. So this time from the International Energy Agency on their strategy towards transition towards net zero emissions. You may have seen and heard that it's kind of created quite a bit of vibe in the scene, because I think basically on the one hand, it shows obviously that time-wise we're in a very kind of narrow path, but yes, overall it's possible that we still kind of transition towards a net zero scenario in time. Fundamentally to that is obviously the kind of rebuilding, the reconstruction, the transformation of the energy sector, and renewable energy is playing an absolute key part of that. And I think what came across this report, but also other reports of the OECD and of other institutions' analytical work, obviously shows that renewable energy is becoming, and in many countries already is, the least cost alternative, obviously, to energy production. It provides access to those that are living remotely, and it's also an engine of growth and jobs. So, and obviously, it will also help countries not to be with stranded assets of fossil fuel power plants, particularly as they are currently. Obviously, we know that they are most likely obsolete going forward, and certainly not in line necessarily with the transition towards net zero emission. So basically, on coming back to the private finance mobilized, we know, as colleagues have been saying, public funding is limited. It will grow probably, we all hope, and we kind of argue for that, but obviously private finance is critical. So what we need to do, and that's the work that the OECD is doing, is providing policy guidance besides analytical work to its members and to policymakers at large of how to do this. You might know that in 2017, the OECD developed, together with many other actors from across the community, if you like, EFIs, MDBs, think tanks, bilateral actors, alternative asset managers, CSOs, the OECD blended finance principles, and they basically deal with issues of anchoring blended finance in the development rationale, in really designing programs that aims to mobilize commercial finance from the very beginning, to tailor funding to the local context, to aim for effective partnerships, and obviously to put also into place the right transparency and monitoring work. So these principles have been taken up not only by OECD countries, but I think more broadly. They have been recognized by the G20. They also led to a very, very interesting process that was launched in 2018 in Bali, at the margins of the annual meeting of the World Bank and IMF. It's a Balinese title, the Trihatha Karana Blended Finance Roadmap. And this roadmap has now grown to something like 100 organizations from 25 countries that are dealing with issues of blended finance and how to make blended finance approaches more effective, create better outcomes and impact, and obviously mobilize more funding for better development. The guidance, Cecilia, that you referred to is a consequence of this work, both from the principles, but also from the Trihatha Karana roadmap, plus also an additional work that we have been doing with many partners from across the development finance community on certain areas, for example, also on water, but also on energy. And what we now like to do, and you have to refer to this, Cecilia, is to take this step, this guidance, the principles, one step further, and really look into how we can use blended finance approaches more efficiently to mobilize climate finance, including clean energy. Here, obviously, you know, yourself, ourselves, and other parts from across the OECD, I think we are pulling together knowledge that we have, be it on the development financing, on the mobilization of private finance, on creating the right domestic enabling environments here, and really try to create if you like, a good, sound, evidence-based policy guidance, and also practical guidance for our members and other key stakeholders. So we are really looking forward, as always, to work with many other colleagues from across the spectrum together to come up with something that really makes a difference. With that, back to you, Cecilia.
Thanks very much, Haya, for your remarks. Now I'm going to turn to some of the questions that have been submitted to us in the Zoom. There's one colleague who's asking about how to build regulatory knowledge or framework knowledge to facilitate investments in countries where the regulatory framework is not as well developed. And another question, I think targeted to Pak Kosi, around experience that has been done in Indonesia around the retail green sukuk, and whether SMI or others will have similar programs to enlarge public participation in finance for clean energy or SDG investments. I don't know if anyone of my panelists would like to jump in and respond to any of those questions.
Okay, Cecilia, allow me to answer probably the question that to SMI. So relating to the retail sukuk, the green sukuk, I think PT SMI in 2018, we are the first corporations to issue green bonds in Indonesia, because I think the OJK has issued the POJK 60 specifically on green bonds. Since we are the first corporation, so we are the one that discuss and set the standards on the green bond impact reporting and what are the mechanisms to be done in the process here. However, the lesson learned from that the green bond issuance, that the investor is mainly the same investor as the conventional bonds, and then there are not many incentive that is given to the people, to the company to issue further green bonds. However, this issue has been discussed with the local regulators and the government to take some actions forward to make sure that probably incentive is being announced, so people are getting more and more savvy in issuing green bonds. Yeah. And I think another initiative from PTSMI itself is actually when we are financing the green projects, we are also asking the debtor to create some sort of a green framework and trying to measure those green impacts, benefits from each of the underlyings, and then do some capacity buildings on how the green bond process is being done. So hopefully with this kind of effort, we can get more people to issue the green bond. And hopefully when the government can issue some sort of a regulation, either through incentive or let's say a requirement to put some of the investment through the green underlying, that can help to support the development of the green financing, specifically in the capital market area.
Thank you very much. Did any of my other panelists want to react to any of the questions?
Cecilia, maybe if I could just react to, I think there's a question around, the clean energy regulation in sub-Saharan African countries. So maybe just to respond to that, at least in the South African context, I think it's quite key that the regulations, allow kind of the rollout of what you're trying to deploy. So to give an example, with the Embedded Generation Program, when we applied to the Green Climate Fund, the integrated resource plan for South Africa was still very much in a draft format. We were still awaiting a lot of comments from the public. So when we got the approval from the GCF, there were obviously subsequent changes in the regulation, in terms of how embedded generation was defined, which meant that we had to go back to GCF to amend, the funded activity agreement, and that can cause, some delay in terms of implementation. So yes, I think it's important that, and I think we were quite advanced in terms of that type of regulation, and it may not be the same, for other countries, especially SADC member states. So I think one lesson that we've learned, in terms of trying to implement the Embedded Generation Program, it's quite key that when you're trying to mobilize, especially climate resources, such as a GCF, that the regulatory environment, must be, must be supportive of what program you're trying to implement. Otherwise, it can be a challenge to get things on the ground moving. Thank you so much.
Thanks very much. And I also just want to highlight, I think under the new project that Haya mentioned, my colleagues and I will also be looking at the enabling environments and ensuring that we do have the right policy frameworks in place. Because what's I think been quite clear in conversations with people is that blended finance cannot fix what's wrong in the policy regimes, and that capital really needs to be targeted towards projects that have commercial strength. So having the right enabling framework is really a fundamental underlying requirement to be able to mobilize private capital. And it's really around addressing what are often perceived risks. Torben, you have your hand raised. Would you like to?
Just a small remark. I think it's important to be aware of the fact that we are now moving into, let's say, we call it version 2.0 when it comes to the use of clean energy. Until now, we have mainly looked upon say wind and solar power as a way to produce clean electricity, and we are sending the green power into the grids. That's fine, but actually increasingly the capacity of green power is becoming so large that the green power is slowly being transformed into a natural resource, the input resource into the production of green fuels, green ammonia. I think that many emerging markets are very well positioned. Many emerging market countries are very well positioned to use, let's say, solar power from solar plants to establish production facilities to the production of green ammonia, which is a green fertilizer for agriculture, and also green fuel to the heavy transport industries like shipping, heavy vehicles, and in the air industry. So because the price for solar power especially has come down, you have a very cheap natural resource to produce let's say green fuels, which will be in high demand in the coming decades. So I think that we should broaden the perspective of what is clean energy. It's not only green power to the grid, it's one of the most precious resources in the total climate transition going forward.
Thanks very much. And I think that points also to an interesting point about looking at blended finance to also support new technologies. And this is something I think that's come out of the theme report as well. We are pretty much out of time, so I just want to allow my panelists, if they do need to leave, to sign off. I do want to take that last question if the panelists agree. And this is directed to Pat Gozi. What makes a state-owned DFI different from other DFIs, considering that incentivizing commercial investors is a concern for all development finance models?
Okay, Cecilia, thank you. I think from the question is actually we already knows that from the plan from the government, it makes about 6,400 trillion rupiahs to finance development of the infrastructure projects. And I think the state budgets and the municipal budgets only can cover about 30 to 37%. And about 40% will be expected to come from the private sector. So I think it's a good incentive that what we are doing is actually getting how to get the commercial investor to come. Yeah, specifically for Indonesia, there's a number of toll roads projects that's already operational. So and the number of investors can come in. And Indonesia already have also an institution called the Software Wealth Fund, the IMA. Yeah, so now focusing to support the equity investment specifically for these projects. And another scheme that actually the government is focusing also is actually to create some sort of PPP projects, number of PPP projects in multiple sector, water, the green sectors. Yeah. That the private sector can finance, and also the specific blended financing that I was explaining before is actually also targeted in the private sector. So hopefully that can answer the question. So number of initiatives that is we are doing to get the collaboration to get the private investor money in, because I think there's a limitation of the other financing, specifically say on enterprise and also the state budgets. To sponsor or to finance all of the infrastructure projects. I think that would be my answer, Cecilia.
Thanks very much for that reply. Well, I'm afraid we're out of time now. I'd like to end our session and just to say we've had a lot of very interesting experiences shared amongst our panelists today, and it's very clear that there's a lot of potential to design blended finance schemes to have more of a catalytic impact to crowd in commercial finance. The OECD, together with partners such as EIB, CIC, will continue to work more on this theme. And I'd like to just thank all my panelists here for really spending the time and sharing their experience with us. And we look forward to working with all of you more in the future on really how to make blended finance mechanisms more effective in mobilizing commercial capital. Thank you very much and have a great weekend. Goodbye.